Let me move on straight, and I want at this moment to transition to introduce Matthew, who is the Executive Director of Acorn Investment Management Limited and is responsible for overseeing the REIT management business, which includes investor relations, asset management, governance, and our retail aggregator platform, Vuka. Matthew has over 17 years of experience in investment management and administration of funds, including segregated retirement funds in East and South Africa. He's an alumni of the Oxford Real Estate Program and holds a bachelor's degree honours in actuarial science from the JQuat and is a certified full member of ICIFA, that's the Institute of Certified Investment and Financial Analysts, and also holds certifications from the Chartered Institute of Securities Investments and other similar institutions. He is the current chair of the REIT Issuance Committee at the REIT Associations of Kenya and also sits in the RAC Main Committee. Ladies and gentlemen, welcome in Matthew Minor. Welcome, sir.
Thank you, Minor. I'll start off from where Peter left off. He gave a fantastic overview of how performance has been on the establishment phase. Then he went on to show how the portfolio would perform once we eliminate some high-cost debt that we're sitting with from the I-REIT. And then he went on to show some of key parameters in terms of what we expect looking forward. But let me bring it all together. So when we launched the REITs in 2021, the first 4 years of the REITs, we've operated in environments that have been both turbulent, tough, but significantly this period has enabled us, and specifically for the REIT, to understand the resiliency of the portfolio. We've seen, and you'll see later as we talk about the numbers, that despite a lot of macroeconomic, a lot of global geopolitical impacts on things like currency, on interest rates, inflation as well, you see resilience coming through. And that's something that is not new to any business in Kenya. However, when you look at our specific subsector, which is purpose-built student accommodation, specific to it, there are certain things that I would like to highlight that are that we've experienced over the last 4 years generally, and we'll see them from a cyclical nature coming through. And as you would remember, what Edward says, one of the key pillars of REITs, and especially where they sit on a risk-return basis, is the resiliency that they bring to any portfolio and any person who's invested in that. 2019, we had COVID, and as you all would remember, we had disruptions in education, closure of universities, and even when we were able to come through out of that, we had extended periods of disruption in the university calendar. We had disruption in enrollments of universities. And we still see some of those institutions, I think in 2024 is when they have fully recovered. So an extended period of that. In 2021, as we continued to develop and achieve scale, we experienced health and safety incidences, and they had a significant impact in the developing portfolio. And most importantly, on the delay in completion of projects, because of once you have an incident, you have to stop that incident, look at the key issues that are there. And obviously you have, from a metric perspective on any project, which is internal rate of return on how that project is and the time that project is being completed, you had that impact, especially on the developing portfolio. And later on, you will see, as Peter has mentioned, the scale that we have achieved and also on the establishment phase, the impact it had. I think interest rate regime is something that was experienced globally. Kenya was not unique in that perspective. But between mid-2022 to actually towards the end of 2024, we had a regime of high interest rate regime. We saw government coming into the market, crowding out private sector. Interest rates at bank level went extremely high. And you had Edward mentioned earlier why mortgages are not taken up, because when those interest rates go up, they impact the debt that you're holding, and therefore they're quite dilutive to the equity of an investor. And we saw that regime impact the debt component, especially on the I-REIT. And you could see Peter spent a bit of time just showing you how the impact of high cost debt has, especially on the I-REIT, which is quite interest sensitive. Even in 2024, we saw another shocker being thrown in there with a university funding model. And we've seen what that has done coming through to universities, disrupting enrollments into universities, funding models for students who rely heavily on government funding and even sponsor funding. And therefore, over the first 4 years, we've still continued to experience these turbulent times. But nonetheless, the REITs have delivered returns. And Peter went into the financial aspect. I'll talk about the return aspect of the REITs in the next slides. So let's talk about the first 3 years of the REITs, which we call the establishment phase. And this was a period where the REITs were launched. You are scaling the portfolio in both the development side and the income side. You are consolidating that portfolio. You are originating new assets and you'll see later the impact of those originated assets coming through. And importantly, these REITs were launched as 2 REITs, a development REIT and an income REIT. And they were predominantly offered at that time to institutional investors, where an investor came in and put in 30% of their money in the development REIT and 70% of their funds into the income REIT. These 2 REITs derive returns from 2 pots. One is the capital appreciation of the unit price, because you acquire a unit similar to how you would acquire a stock, and dividend distribution, what you would call what ideally is your cash back to you for holding that sort of investments. The 2 REITs over this 3-year period have delivered a total blended return of 23.9%, close to 24%. But this blended offering has only until now been available and been offered only to institutional investors. We launched Vuka in 2021. Late 2021, around September 2021, and Vuka members to date have predominantly invested only in the I-REIT. The I-REIT for that period has delivered a total cumulative return of 22.5%, and when you annualize that, is 7.9%. And that has been built up of an appreciation in the unit price, and as you can see, 20 to 22 shillings during that period of the first 3 years, and also paid out a dividend, which is a cashback return back to you in that sense. We've singled out 2024 because the first phase was the establishment phase. 2024, the portfolio had grown, consolidated. Peter mentioned earlier about the D-REIT. When the 2 REITs were launched, assets were seeded into the REITs, and he's gone through that impact. I won't repeat that. But as the D-REIT own originated assets have come through, it's completed its project, you've seen that value get realized. And you can see the D-REIT is now delivering double-digit returns. And in 2024, from a return perspective, he showed you from a profit perspective and absolute numbers perspective what that number translates to. But from our investor perspective, that is 13.1% in 2024. Despite the elevated cost of debt in the I-REIT, the portfolio scaling that the debt allowed us to do enabled us to achieve high rental revenues. And for the first time, the I-REIT crossed the 1 billion mark in revenue. And you could see that coming through from a return perspective. Dividend distribution are coming through, and also the scale of the portfolio, the number of properties, that fair value gain are contributing to the 7% return, still with a high cost of debt in the portfolio delivering more than 1.1% in return. From a blended return, because of that scale, because of the execution of strategy in the 2 REITs, we've seen a doubling, more than a doubling, close to a doubling of the blended return from 4.5% to 8.8%, and you will see this going forward as the portfolio consolidates, as we continue to execute our strategy, as Edward mentioned, as we expand into Tier 2 towns, as we exit assets right on time, as we continue to operate the assets effectively and efficiently. You'll see a period of double-digit returns going into 2025 and beyond. But how do those numbers look like? So we have scaled the portfolio. We're now positioned for double-digit returns, and you can see the D-REIT continues to benefit from the value creation of its originated assets. We are entering a period of high distributable income as we are exiting assets as that portfolio revenue continues to grow in the I-REIT. It's a period of steady and stable net asset value growth, which is a stable unit price holding. Edward showed you on the risk return where a REIT sits, and specifically the Vuka product, which is to achieve bond-type returns, although it behaves like an equity investment because you're buying units like stock. But because of the dividend distributions, it behaves like a bond-type return because it gives you steady returns similar to coupons. But what will that be driven by going into the I-REIT coming through to deliver double-digit returns, as he showed you, driven by management of the debt costs towards making sure that you're lowering that debt cost, replacing expensive local debt with much cheaper debt and full equity where available, and therefore driving that absolute return for you as an investor in the I-REIT into near double-digit returns. And blended returns, we are seeing now the two REITs edging double-digit returns as they trend upwards towards the mid 13%. And as we continue executing our strategy over the next 10 years, you will see these numbers tick high towards the higher teens in that sense. Significantly for us, that is how the numbers look like from a portfolio perspective. It will be driven by the portfolio scaling, execution of strategy, and most importantly, managing of debt, especially in the I-REIT. Thank you, and I'll see you during Q&A.